How can Japan owe more than twice what it produces in a year and still not crash? For 3 decades, economists and investors have pointed at Japan's balance sheet like it's a ticking bomb. Government debt sits well above 200% of GDP. The central bank spent years pinning long-term interest rates near zero. The population is shrinking and getting older. On paper, this looks like a recipe for crisis, and yet the explosion never comes. Markets panic elsewhere. Japan lopes on. So, what's really going on? The easy answer, the Bank of Japan prints the money, isn't wrong, but it's incomplete. Japan hasn't survived on a magic trick. It has endured because of an ecosystem, policy choices, demographics, and household saving habits that lock together like gears. That system trades drama for drag, crisis for caution. The risk hasn't disappeared, but the machine, for now, still turns. Start with the interest rate that matters most for governments, the 10-year bond yield, the price of time. For most of the last decade, the Bank of Japan didn't just influence that price, it controlled it. The policy was called yield curve control. In plain English, the bank announced a target for the 10-year Japanese government bond, around zero, and then promised to buy as many bonds as needed to keep the yield from drifting much above that target. Imagine a soccer match where the referee is also playing for the home team. That was Japan's bond market. The goal wasn't to show off, it was a bridge. Hold down borrowing costs long enough for the economy to heal from decades of weak growth and too low inflation. That bridge only worked because of who owns Japan's debt. Unlike many countries that rely heavily on foreign creditors, Japan's IOUs mostly live at home. Banks hold government bonds because regulation and habit treat them as the cleanest collateral you can park on a balance sheet. Life insurance companies and pension funds hold them because their promises, annuities, and retirement checks are in yen, and they need safe, yen-denominated assets to match those obligations. Households, older, cautious, and scarred by the late 1980s asset bubble, prefer cash and deposits, which flow to banks and insurers, and then into government bonds. Even the nation's giant public pension fund anchors a large share of its portfolio in domestic assets. Add the central bank's own holdings, at times, over half the bond market, and you get a closed loop. The state borrows in its own currency. The nation saves in that currency. And the central bank stands ready to be buyer of last resort if the loop wobbles. Demographics paradoxically support this loop. An aging society does strain public finances through more pension and healthcare spending, but it also suppresses the economy's natural interest rate, the rate consistent with steady growth and stable inflation. Older households tend to spend less, chase fewer risky returns, and value stability over yield. That dampens wage and price pressures and makes ultra-low interest rates feel normal rather than artificial. In that environment, yield curve control wasn't fighting gravity. For years, it was surfing it. Inflation stayed low. The Bank of Japan kept the 10-year yield caged, and the debt could be rolled over cheaply. There's another piece people often miss: the difference between gross and net debt. Gross debt is the headline number, everything the government owes. Net debt subtracts government-owned assets and the bonds held by parts of the public sector. Inside Japan's system, a lot of the interest the state pays circles back. The Ministry of Finance issues bonds. The Bank of Japan buys a big chunk. The interest income shows up as central bank profits. Those profits are remitted to the treasury. It isn't a free lunch. Balance sheet risk still exists, but it changes the mechanics of panic. When your largest creditor is your own central bank, and your next largest are regulated domestic institutions, you're less exposed to the classic sudden stop, where foreign lenders flee and demand repayment in a foreign currency. None of this comes without a cost. When the Bank of Japan promised to cap long-term yields and the rest of the world raised rates, it had to buy more and more bonds to defend the ceiling. Liquidity in the market thinned. Prices printed, but real trading shrank, and the central bank accumulated interest rate risk on its own balance sheet. The side effect showed up in the currency. As the United States and Europe offered higher yields while Japan stayed near zero, capital flowed out, and the yen weakened sharply. That was good for exporters but made imports dearer, finally waking inflation after decades of drowsiness. In response, the bank widened the yield band, allowed more drift, and began nudging the framework toward flexibility, not surrender. Adaptation. The bridge had done its job. The economy needed a little movement. So why no collapse? Because Japan has traded one kind of risk for another. Instead of a sudden crisis, it accepts a slow arithmetic, modest growth, low rates, and debt that is continually rolled. Instead of a bond market strike, there's an ongoing negotiation between wages, prices, and a cautious central bank. Instead of foreign creditors demanding reforms, you get domestic savers quietly absorbing government paper because there's no other asset that matches their liabilities and risk appetites as neatly. The cultural anchor is household behavior. Japanese savers love cash and deposits. More than half of household financial assets sit there. After the bubble burst, generations learned a hard lesson. Capital gains can vanish. A passbook endures. That habit frustrates growth hawks because it channels savings away from risk-taking, but it greases the fiscal machine. Your deposits become your bank's assets. Your bank buys the state's debt. The state pays your pension with the money it borrowed from you. Imperfect? Absolutely. Resilient? Also, yes. When shocks hit, deposits don't sprint for the exit. They sit. This stability rests on three fragile pillars: confidence, currency, and time. Confidence, because the loop holds so long as households and institutions believe inflation will stay low and the system will honor its promises. If people conclude that inflation isn't a blip but a habit, they'll demand higher yields on deposits and bonds or shift into riskier assets. Banks and insurers would need to rethink their bond diets, pushing market rates up and lifting the government's interest bill. Currency, because a weaker yen helps exporters until it unnerves consumers and politicians. If depreciation turns into a rout, Japan would import a problem it can't sterilize with patience: surging prices for energy and food. Authorities have shown they'll step in to stabilize the yen when moves look disorderly, because confidence in the currency is the backbone of domestic financing. And time, because demographics cut two ways. Today, they help keep rates low. Tomorrow, they raise the dependency ratio and shrink the tax base. Even with low yields, a smaller workforce supporting more retirees means heavier fiscal arithmetic, absent stronger productivity and higher labor participation, especially among women and older workers. The math grows tougher each year. There's also classic market risk. As the bank lets long rates breathe, they can inhale surprises. A sharp, disorderly jump in yields would hit bank bond portfolios, tighten financial conditions, and test the bank's willingness to step back. Could the central bank return to heavy buying? Yes, but every round leaves it owning more of the market it is supposed to referee. At some point, liquidity becomes theater. Prices appear, but meaningful trading thins. If the risks are real, why persist with the pragmatic middle? Because the alternatives look worse. Austerity, big tax hikes or spending cuts would likely crush growth and, paradoxically, weaken the tax receipts needed to stabilize debt. Rapid rate hikes would shock balance sheets without guaranteeing a stronger currency. Forcing households into riskier assets would clash with demographics and culture. You can nudge portfolios, but you can't order people to crave volatility. Japan's strategy is to manage, not defeat, the mountain. Keep debt service affordable by keeping average borrowing costs low. Nudge wages and prices up gently, away from deflation but not into a spiral. Recycle household savings through institutions that can hold duration. Gradually widen the edges of the interest rate cage so the bond market can remember how to be a market without burning the house down. In practice, that means careful, incremental policy shifts rather than grand resets. It means building credibility by doing the boring things consistently, communicating clearly, avoiding surprises, and letting the economy absorb small doses of normality. For viewers outside Japan, here's the broader lesson. Many advanced economies are aging and running persistent deficits. Japan is not a paradox or a punchline. It's a preview. It shows one possible equilibrium: slow, orderly, frustrating, and, compared with crisis, survivable. The social balance sheet matters as much as the fiscal one. A society that values stability can, for a long time, finance its state at very low yields in its own currency, especially if a credible central bank is willing to be boring for a very long time. Think of the system as a set of quiet understandings. Savers accept low returns because safety is worth more than yield. Banks accept low margins on bonds because they need pristine collateral and stable balance sheets. The central bank accepts an outsized role because the alternative is a bond market that tests the limits of a fragile recovery. Politicians accept slow reforms because sudden ones tend to backfire. None of these choices is costless. All of them buy time. And that, more than anything, is what Japan has been purchasing. Time to grow productivity. Time to raise participation. Time to let wages catch up to prices. Time to gradually normalize policy without ripping out the floorboards. If you're waiting for an avalanche, you might miss the lesson. Collapses are dramatic. Compacts are quiet. Japan's debt mountain hasn't collapsed because it isn't hollow. It's buttressed. Yield curve control damped the gusts. Demographics lowered the wind. Household savings tied quiet ropes from the summit to the ground. None of these guarantees safety forever. If inflation habits change, if the yen slide turns into a rush, if politics loses patience, calculations that held for 30 years can fail in 3. But today, Japan's debt is supported by a social compact as much as a financial one. The state offers stability. Savers Savers accept low returns, and the central bank moderates the pace of change. Maybe the better question isn't, why hasn't it collapsed? But what does it take to keep it standing? The answer is less dramatic than you'd expect. Trust, patience, and a very careful referee. The debt won't vanish overnight, and the risks won't go away. But equilibria don't have to be exciting to be real. Not all mountains fall. Some endure, slow, orderly, and, yes, frustrating, until you compare them to the avalanche.